Producers and creators are the sources of all value on the planet. MC Lobster, the host of the top-rated business and investing podcast Cashflow Ninja, is on a mission with Producers Wealth to help producers create, protect, and multiply their wealth outside of Wall Street in any economy by creating systems and processes that help them increase their production, provides them with liquidity, passive income generators, and opportunities for enormous growth. Learn more about their time-tested and proven systems at yourownbankingsystem.com. That's yourownbankingsystem.com.
Welcome to the Cashflow Ninja, the podcast sharing how to create income streams and manage, multiply, and protect your wealth in the new economy. Here is your host inside the dojo, MC Lobster.
Hello, Cashflow Ninjas. MC Lobster here, and welcome to another episode of the Cashflow Ninja. I have a great show for you today, and in today's show, we're going to look at how to perform due diligence on private investments. I'm joined by my friend Andrew Lanoie. Andrew is the CEO of Four Peaks Capital Partners. Andrew is an expert at building teams and connecting people with opportunities. Formerly a talent agent at William Morris for 16 years, he represented some of the world's biggest celebrities, including Tim Allen, Sheryl Crow, Barry Manilow, and Peter Frampton, just to name a few. In 2009, Andrew began investing in the alternative asset class and acquired over 100 income-producing assets in less than 48 months. During this time frame, he discovered a massive gap in the market, which of course goes along with the opportunity presented, and chose to leave the agency to pursue the lucrative opportunities in the private investment sector. Due to Andrew's success, he was approached by business associates and friends who were interested in partnering with his companies. Upon counsel, he decided to form a private investment group that allowed qualified investors to co-invest with his group. Once Andrew discovered and found success in the private investment sector, he chose to never invest in Wall Street again. Looking forward to this great discussion where we will discuss how to perform due diligence on private investments. You can also grab a free report that Andrew and his team has put together at privateincomeinvesting.com. That's privateincomeinvesting.com.
Are you an investor looking for passive cash flow but don't have the time to explore your options? Discover real estate. It's the best option for passive income that savvy investors have been turning to for years to generate income and build wealth. But the reality is real estate investing takes expertise, market knowledge, and time. So what do you do if you don't have the time or market knowledge? Discover how many business investors have found a way to generate cash flow from real estate investing. Their secret? They partner with proven private real estate investment funds. Four Peaks Capital Partners have created a system that allows accredited investors the opportunity to invest in undervalued assets to generate passive income and capital gains. Invest with the cash flow experts and sit back while Four Peaks does all the work. Call Four Peaks Capital Partners at 877-5-INCOME. That's 877-5-INCOME, or go to privateincomeinvesting.com. An offer to buy or sell securities is only made by a private placement memorandum. Prospective investors must read the PPM in its entirety before making an investment decision.
Andrew, welcome to the show.
Hey, MC, thanks for having me.
Yeah, great to connect again. Now, Andrew, for my listeners that's not familiar with you and your company, can you please give a little and share a little bit about your background and your journey?
Absolutely. So I'm the founder and CEO of Four Peaks Capital Partners, and I'll give you a quick background and kind of bullet points on just quickly on me. I spent the last 20 years in Los Angeles and worked as a talent agent at a company called the William Morris Agency, which is a pretty big talent agency representing A-class celebrities, basically, and had a great run there. I was there for 16 years. When the subprime crash happened, my folks had lost a bunch of money in the downturn. They were retired. And so that was kind of my big eye-opening, what the heck happened event. And it led me to reading a bunch of books on economics, and it all kind of pointed me into real estate investing. And in late 2009, I started buying single-family properties, starting out in Dallas, Texas, and that led to properties in Memphis and then Atlanta, and built a small turnkey company in Atlanta with some partners who had moved there. So from about 2009 to 2013, I bought over 100 properties with partners and really cut my teeth on the single-family investments. And during the course of time, realized that that's really the path that I needed to be on, was real estate investing. And so I exited the talent agency in 2013.
Very interesting background, and you guys are involved in the mobile home park industry, which is very, very interesting as well. What are some of the attractive features about this niche in real estate? And what are some of the things that excites a lot of investors investing in this space?
Yeah, it's a great question. So basically, after probably 2013 and 14, I stopped buying single families because the numbers just simply stopped penciling out. The cap rates were getting lower. There was a lot of investors coming into the market. So we're looking around and we're looking for basically the next investment. We looked at commercial, we looked at multifamily, we looked at a number of other asset classes, including mobile home parks. And we chose mobile home parks for a couple of reasons. One is that the cap rates were considerably higher than the other investments that we were looking at. So they were income producing. We felt like there was still great deals to be had on that. And it's also somewhat of an overlooked niche. So while other people were looking at apartment buildings and things like that and picking up things at 5 caps and 6 caps and whatnot, we were able to start buying mobile home parks at 8 caps, 10 caps, 12 caps, and sometimes even higher.
And this brings it to this environment right now, and a lot of other guests have mentioned it as well when they talk about multifamily, that cap rates are really compressed. So they're looking at alternative vehicles and found this vehicle that's not only very, very attractive with returns right now, but the track record that it has. I mean, it truly is a recession-proof vehicle.
Yeah, it's a really interesting asset class. I mean, first and foremost, it's hands down, it's affordable housing. We're buying communities in the Midwest. That's basically where we're focused, and into the Southeast a little bit. We're operating in 12 states right now. I think we own 24 or 25 communities. And so first and foremost, it's affordable housing. So you have to have a team in place to operate these. We have a national property management company. We have a national construction company. And our focus, kind of a niche within a niche, has been on distressed mobile home parks, which has been interesting. So we'll go into a market and find a community that simply has been neglected for years. And maybe 15 years ago, it was at 95% occupancy, and for whatever reason, the owners have basically just let the community run into the ground. So whether they stopped putting money into it, or they had problems managing, or they were managing out of state and didn't know how to do that. So interestingly enough, we really found a niche within a niche, and because we built a big team, we've got over 100 employees right now. We're able to go and find a lot of deals that other people really wouldn't touch because there's just too many issues. So that's been interesting to focus on that.
What are some of the risks that exist within this space? Because in every asset class, there's certain things that you have to be cognizant of and that you have to not only mitigate, but you have to manage. What are some of the risks that you need to manage and be cognizant about in this particular niche?
Yeah, I think the biggest thing, and I would say in most real estate investments, and probably in most investments, is you've got a risk with the asset class and you have a risk with the operator, whoever the sponsor is. So on the asset class side, we feel great about mobile home parks and being in the affordable housing business, and looking at all the data that we've reviewed on this. historically it rides through a recession really unscathed. So when you look at this compared to other asset classes, especially through the subprime crash, mobile home parks came out and did really well. And if you think about it and you put, new construction condos as an example up against mobile home parks, generally when there's a recession, all the cranes that are in the air kind of stop for a while. And someone who is living in a 4-bedroom house and loses a job, they're probably not going to be homeless, but they're going to downsize to maybe a 2-bedroom. And so you've got the top-down theory, and we're really towards the bottom of the housing chain. So we don't really compete with single-family home buyers or single-family properties. I mean, we're really competing with apartments, and in our average, the range of our lot rents are typically about $200 to $300 a month. So, I mean, we're really, really in that affordable housing sector.
That is one of the assets that, as you mentioned, historically has been very, very interesting in my research too, to see how, it really, really rides through turbulent times. One of the other things that we've touched on the podcast a little bit is the concept of diversifying within a particular asset class where your knowledge lies, your strength, your connections, your network, and so forth. Can you speak a little bit more to that and share some of the strategies that you help investors implement in achieving that?
Absolutely. So diversification within an asset class, we spent a lot of time talking with our investors about what was important to them, and a couple things stood out. One is income, and the other was growth, and obviously the capital preservation. So fortunately, in this asset class, we were able to put together several investments that achieved all of those. So we've got, just as an example, we've got a lending fund which we launched previously, and essentially it pays out a higher rate of return. It's structured as a debt fund, so that, for example, doesn't have any tax benefits. So a lot of our investors with IRAs like it because it's a higher rate of return that's going to compound faster, and they're not really worried about the tax consequences, for years down the line until they start making distributions. And then we have an acquisition model where investors are seeing tax benefits through depreciation. They're seeing fairly strong income on the front end, and then a significant part of the back end on a sale or a refinance. So that's two pretty good examples of how you can diversify within an asset class. Our mortgage lending fund, as an example, is we create mortgages for new residents coming into the community. So it's a different side of the asset class versus an acquisition fund where we're going and buying new communities and then turning them around.
You're listening to Andrew Lanoie on the Cashflow Ninja podcast. We'll be right back after a word from our sponsors. My friend Dave Zook from The Real Asset Investor says you can be conventional or you can be wealthy. Pick one. The Real Asset Investor team creates value for investors looking for high yield returns from multifamily apartments, ATM machines, and self-storage investments. Their syndications offer attractive investment opportunities that produce strong cash flow, equity growth, huge tax incentives. They are truly passive and managed by a world-class team. To learn more about the exciting investment opportunities the Real Asset Investor offers, such as their multifamily, ATM, and self-storage syndications, please visit cashflowninja.com/Real Asset Investor. You're listening to Andrew Lanoie on the Cashflow Ninja podcast, and now back to our interview. So within the mortgage fund, those mobile home park homes, they are owned outright by the owners, right? On the property that you guys own.
Yeah, that's correct. So it's a first position. It's similar to it's set up like a lending fund. So it's first position, that's the security on it. And we essentially use a third party to originate. We find a resident, the resident comes in and we qualify them, and then we put them into this We put this into this mortgage essentially for whatever the term is. I think it's 10 years, and then investors have the option to exit it at 5 years.
Very, very interesting. Yeah, and I mean, as you mentioned, it gives you two opportunities there. One of having an equity position within the property, and then also a debt position that's backed by the homes that's on the property. So you truly do diversify yourself within that particular investment.
Yeah, and we found that investors are always looking for different things. I mean, some people are thrilled with a 12% fixed rate of return. Again, if they're using an IRA or a pension or some sort of a self-directed vehicle, that's going to compound faster. Maybe someone's looking for just an overall stronger return versus a fixed rate, so they're going to go with the acquisition model. So we found that giving folks a couple different essentially choices has been a great thing for them.
Now, one of the things I wanted to talk to today about, which you've provided some great content and information on, is due diligence. Now, due diligence is so important in today's environment because there's the internet. It's very, very easy to access the internet and post information on the internet and so forth. So there are a lot of folks within the investment community or on the internet advertising certain opportunities. So this becomes more and more important to really, really do your homework, vet folks properly. So what are some of the ways and some things and necessary steps that people need to take when performing due diligence on an investment?
Yeah, it's a great question. So I get asked quite a bit just on due diligence and, investors asking how they do that. So maybe a good place to start is just backing up a little bit. And in my opinion, the most lucrative sector that entrepreneurs can be involved in is private investments, especially in the real estate sector. I'm a big real estate guy. I'm very much a Main Street versus a Wall Street person. I'm sure you know Simon Black, and he pointed out at one point that with big public companies that are listed on the stock market exchanges, it's not uncommon to pay 20 times, 50 times, or even 100 times a company's annual profit. And he was referring to Amazon that was selling for 180 times its annual profits. But with the private companies, you pay a fraction of that price. And of course, you have direct access to the decision makers, very much unlike the stock market as well. So until recently, these investments have been reserved and only shared with a small circle of people. And if you weren't connected, you were basically out of luck. And a lot of people have heard about the Jobs Act. And so that's an important part of this. So about 4 years ago, it's actually called the Jumpstart Our Business Startups Act, or that's the Jobs Act. It was passed by Congress, and it allows private companies to advertise its investment to potential investors. So the once lucrative investment opportunity is now open to qualified investors today. So basically, you can avoid the middleman and all the fees that typically happen in public companies or the stock market. So a couple things just to touch on. I've got a report that I can share with anyone who's interested, but a few things just in terms of vetting companies. And just the importance of due diligence. And the first is verify the offering. So almost all private offerings require the sponsor, the promoter, the operator to publicly file information about their offering with the Securities and Exchange Commission, the SEC. So you can review their filing in a public database called EDGAR, EDGAR, and the process is very simple. I've got detailed information on how to do this in the report that we put together. So that's the first thing. The second is the legal document review. And it's amazing what you can tell even from a cursory review of legal documents. And in general, most companies that have the private real estate investments are using something called a PPM, or a private placement memorandum. So that's the first thing you should be reviewing. And we always recommend that if you have a real estate attorney or attorney, that you have someone review that. But you'd be surprised at how many people don't bother with a PPM. And they always have excuses of why they don't need one, or it's a small offering, or it's just reserved for close family and friends. And that's certainly a pretty big red flag there. The reality is they simply don't want to spend the money to do it right, and they just want to cut corners. So if they're cutting corners there, then where else are they cutting corners? So that's that's definitely a big red flag. Another thing is track record. So it's obviously important if you want to invest your hard-earned money with someone who is doing this for the first time and testing out things with your money. So how long has a company been around? How many units do they currently own and operate? What's the size of their team? There's a lot of things you can find out online, and certainly talking with someone to get a sense of the company and who you're working with. At the same time, investing with a solo business owner or mom and pop group, in my opinion, could be greater risk. So you want to stick to established companies who have a great team and proper systems in place. And a couple questions that I tell people to always ask is, do they have their own track record and a track record of partnering with others and investors? And certainly, I would ask for references. Do they have experience in the sector? It goes back to how many units or lots do they own? How many communities? Some examples of maybe case studies and what they've turned around. Absolutely talk about the team, and that's important. There's a lot of operators that are out there that have very much a skeleton crew. And then things like, what happens if the key principal dies? Like, do they have insurance that covers that? So those are some of the big questions that I tell our investors to ask. And if I'm looking at things myself, then I ask myself.
One of the things you touched on is the track record. Now, there might be younger guys listening and gals saying, well, I'm trying to syndicate something like that, but it might be a first deal. So if an investor is investing, what are some of the things that an aspiring syndicator could do? Is it bringing in someone with that track record? What are some creative ideas that you can share?
Yeah, that's definitely one idea. Is you partner with someone who has some more history or has a track record. You can also start with a small deal. It doesn't have to be a $10 million deal, nor should it be a $10 million deal if that's your first one. I was syndicating single family houses, which sounds funny, but ended up being a great model, and especially the time that I was buying single families, the market was great for that. So you can get in smaller deals and essentially work your way up. I mean, most real estate investors start with buying a condo, buying a single family house. I mean, that's the Kiyosakis, that's Ken McElroy. I mean, they all start small, and then they buy a bigger deal, and then it grows from there. So I think you start small and you build up your portfolio and your track record. Or you partner with someone and maybe you can compress timeframes a little bit. But, I think one of those two ways are probably your best bet.
Yeah, I've seen some folks that are now successful syndicators, and what they did was exactly what you said. They brought in folks with the experience, the track record, the team, the support to assist in it, and that was a good way to do that. So that for investors doing their due diligence, they could see that the right team and the management is in place, and with folks with experience in that. The other point that you touched on too is the plan of succession, which I don't think a lot of folks are even aware of that. But you'd mentioned what happens if the key principal passes away, right? very, very important to have that succession plan in place. And also, can you speak a little bit to, I would say, options in case of a worst case scenario? Is that questions that someone could ask, and is that what should the answers be from a syndicator if someone says, well, what is the worst case scenario? What could happen in this park, and what are my options if it doesn't work out as planned?
Yeah, I think as a real estate investor, you have to go into something with eyes wide open and just know what the risks are. I mean, there's certainly a risk of a market failing over time. That's typically really slow. Detroit is an example of that. It was a booming city, and all the jobs ended up leaving and companies closing, and it basically fell apart. It didn't happen overnight, but that's certainly one. It goes back to what the risks are, and if you put the risks in two buckets, I would say it's the asset class and it's the operator. Within the asset class, you've got the market. You've got how does that asset class do during a downturn, different market cycles, and then you've got on the operator side, has the operator done this before? Are they experienced? Do they have a track record? So there's no guarantees in life. And that brings up a good point. If someone that you're talking to offers a guaranteed return, that's probably the worst thing that you can hear. You absolutely don't guarantee anything. And if someone tells you that, that's, I would immediately walk away from that investment. Just like Clint Eastwood said, if you want a guarantee, buy a toaster.
Yeah, absolutely. So for instance, you'd cover some of the legal side too, of verifying the offering, the legal document review, the private placement memorandum, to have that in place. And it's quite amazing that some folks would still skimp out on that, because as you mentioned, if they skip that, what else are they taking shortcuts on?
Yeah.
But as far as that in the wording of it as well, because there are in some of these memorandums a preferred return. Can you just explain a little bit of the difference with that, or somebody guaranteeing something?
Yeah, absolutely. So a preferred return, the simplest way to explain that is the net cash flow coming out from an investment. If you have a preferred return set up, and let's just say it's an 8% or a 10% preferred return, it simply means that the net cash flow coming out of a deal after all the expenses are paid goes to the investors first. So it's a way to protect the investors, to make sure that the first monies from a deal coming out are going to them first. And then usually it's a split after that. Maybe it's, in our model, we typically give our investors 80% after whatever that preferred return is. So preferred return and guarantee are very, very different. Preferred return is pretty standard, or a fixed return, which in the case of a lending fund, we may offer someone a 12% fixed return, which simply means that they're going to, if someone invests $100,000 and it's 12% annualized, well, they know down to the dollar what they're seeing every year in terms of an annualized return.
Right. Any other closing thoughts around due diligence, Andrew? Because I think this is a very, very timely topic and a very important one for listeners out there.
Yeah, I think that just kind of on closing, one of my mentors had a saying, and he said, the information about the relationship is available at the beginning if you choose to pay attention. It's something I'm paraphrasing, but something like that. So, everyone's got some sort of a gut read on something or people. So, if you've got a red flags going off, or if things don't seem to be adding up, well, go with your gut. If you go back and you think of times when, a relationship fails or something didn't go, there's usually some signs at the very beginning of that, right? So that's interesting. I think that was really good advice that I got, and I definitely listen to that advice to this day.
Absolutely. And I would say, though, too, that there is a lot of information out online. I think I was at a conference where Damon John was speaking to the importance of just the online profile, and he had mentioned that before he even sits down with someone, there's already a ton of due diligence done just on what's available, because there are so many platforms right now that do share information and people do share their experiences with people. So if you're looking at investments or at opportunities, a quick Google search or a search on some investment platforms is also a very, very quick way to quickly get information at hand and other people's experiences with a particular company or individual.
Yeah, it's such a good point, and it is really simple. I remember going to some sort of a real estate event. This is years ago in Los Angeles, and I was sitting back listening to the speaker, and just something was a little off. And it was definitely as one of those, it was a free event, so there's 50 or 60 people in the room, probably newer investors, if not brand new investors. And I literally just did a quick search on this guy, and it was like lawsuit, and there was a group created about going after this guy, and literally the first page, it was just like all this stuff. And so it's so easy. I mean, sometimes you've got to spend more time and dig deep to pull some stuff out, but a lot of people just don't. They just don't even do the bare minimum.
Right. That should absolutely be the bare minimum that you do. And then, when people are looking at partners for businesses and so forth too, I mean, even a quick background check and screen, as far as taking on a partner in the business too, that's also a way of mitigating it, because the information and records are out there for people to be able to do that due diligence as well.
Yeah, and another thing is, if you're partnering with someone, and I don't mean if you're making an investment into an offering, but if you're going to partner with someone, or you're looking at putting in $5 million into something, if you're talking about a big transaction, I would 100% run a background check on someone. You can do that without. I'm not sure if it's legal or not, but you can certainly do background checks on people. But if you get their permission and you have their social security number and all that stuff, you can do a proper one. I would absolutely do that if you're looking to form a partnership with someone, or you're starting a company with someone. I mean, again, you want to get that information at the beginning of the relationship versus the end, right?
Yeah, absolutely. Now, I think we've covered quite a lot of due diligence in areas here and way to manage risks. And two of the things that you touched upon was the asset class, and then obviously the operator, the institutional quote unquote risk. And I think you mentioned Simon Black too. Simon also talks about, market, which kind of ties into this asset class, but then the political and economic risk as well. So for our international listeners out there, that's something to be cognizant as well when you're navigating this exciting time that we're living in, and looking at opportunities and investments abroad in other countries as well. Absolutely. Now, Andrew, you had mentioned there's a report that listeners can go and grab. Where can they find the report and download this report?
Absolutely. So we've got a website set up. It's privateincomeinvesting.com, just like it sounds, privateincomeinvesting.com, or you can send an email to investors@fourpeakspartners.com and just put due diligence in the subject, and we'll get that right out to you.
Fantastic. And any other platforms that they can follow you on, the homepage for Four Peaks?
Yeah, fourpeakspartners.com, and there's a pretty quick sign up there to get our weekly updates and newsletters.
Great. Andrew, well, thank you so much for coming on the show and sharing your journey and your knowledge and providing so much value around this extremely important topic in today's marketplace. Always a pleasure to connect.
Hey, thanks, MC. Appreciate you having me on again.
Are you having a hard time finding great investment properties? Unfortunately, the best deals are rarely found locally. Successful investing begins with the right properties in the right markets. Norada Real Estate provides everything you need to invest in the best deals across the United States. Our simple, proven system will help you create real wealth and passive monthly cash flow. Learn how to find the best deals by downloading your free copy of The Ultimate Guide to Passive Real Estate Investing at noradarealestate.com. That's NORADA realestate.com.
Thank you for joining me again on the Cashflow Ninja. Thank you for all your support. You rock. If you like what you hear and appreciate what we're trying to build here at the Cashflow Ninja, please subscribe, rate, and review our show on iTunes and share our show with family, friends, and your network. If you're not a subscriber to our newsletter, you can sign up for our newsletter at cashflowninja.com or text Cashflow Ninja to 44222. I'm also posting daily videos on Facebook and YouTube and will live stream weekly starting May 2018. To make sure you don't miss any of the live streams, please like and subscribe to my Facebook and YouTube platforms. I'm also dropping content on Instagram daily. Be sure to follow us on Instagram to get in on the action. I want to thank you for spending your most precious resource with me today, your time. That's our show for today. Until next time, live a life of passion and purpose on your terms. This presentation is for educational and informational purposes only. The information being presented and considered does not consider your particular financial objectives or situation, and it does not make personalized recommendations. This material is not intended to replace the advice of a qualified tax and legal advisor or other qualified professionals, and you should not use the information in place of a customized consultation with a licensed professional regarding your specific personal financial objectives, situation, and needs. We believe the information provided is reliable, but we do not guarantee its accuracy, timeliness, or completeness.